Hi everyone, welcome to the stock market update today from Spain. Okay, so grab a pen and paper. You'll want to write some of this stuff down. Now, first things, how are we doing on the NASDAQ? Well, so far, can you believe year to date, you're up a whopping 13%. The S&P is up 12. Now, that's going to become important in a second because I'm going to talk to you about how quickly you can double your money, which might sound a bit casino, but don't worry, we're talking in a safe manner. The UK markets are up 10%, which is unusual, and I'll look at those in a second. The Dow 30, which is only 30 companies in the Dow, remember, whereas there's 500 in the S&P. The Dow's only up 3%. Now, something very important I want to teach you, and I've said it before, but I'll say it again. Look at this. From January, you were rip-roaring ahead. You think, oh my God, this is so easy, this market thing. So you had that delirium, and then you had this despair as it all fell back and you lost everything that you had. And then, of course, you had delirium again because the market went up. Now, remember, basically, whenever you buy, it's either going to do this and this, or it's going to do this and this. That's why we have a stop loss around there. In other words, we want to avoid it when we get that scenario. Got it? Now we're going to come to some of that in a second. And exits, I'm going to talk about CVS, for instance. Past week, how was it? Well, another whopper. Look at that. I mean, this is just getting a bit crazy now, isn't it? What on earth are we supposed to do? 9.5% there. I'm going to look at some of these. But again, a lot of this comes down to how quickly can we double our pension in a safe, orderly manner, with a portfolio which isn't overly reliant just on Nvidia, though I wish I had been, but looks at other things as well. You've got your Amazons and all of these. So there's been a lot to pick from, and that's the opportunity for us right now. There seems to be a lot to pick from. However, it's also the trap of the market because there are things which look like they were getting into and they're actually not. So I'm going to differentiate some of those for you. Now, I said to you, I'm going to teach you a bit. We're going to come into the stocks in a second, but I'm going to teach you a bit. What's the time it takes to double your money? Now, if your rate of return is a mere 15%, it just takes 5 years. Okay, here's the interesting thing. The S&P is 11.5%. So you're just trying to cherry pick and do a tiny bit better than that. Of course, if you can get it up to 20%, then it takes 3.8 years. You might say, bugger that, mate. I'm more than happy with just a 5-year wait. Not a problem. Why can't your IFA or fund managers do that? Why can't they just double your money in 5 years? After all, it's just 15%, and the 11.5 just comes from an index. So surely they should beat that and do it. Well, one reason is they can't hold cash in a downturn. And every time there's a downturn, they're buggered. All right? That's going to really knock them off. Also, they won't invest enough in companies gaining the most. They just will refuse to put more than maybe 5% in a company like this. Well, guess what? Warren Buffett, Bill Gates, the billionaires will put a bit more in there. I'll put as much as 15% unleveraged into my quality companies like that. Thirdly, they'll invest in the wrong countries. So they'll just be racist with their stock picks. I'll only pick British companies. Or I'll pick Vietnamese ones, Chinese ones. And fourthly, they will spray and pray and call it diversification. They're absolute idiots because when the market falls, correlation increases to the downside. All stocks fall. So in actual fact, you want to be out of the asset class completely, i.e., you need to be holding cash. They can't do it. Anyway, I'll summarize for you why your money isn't doubling, even with the modest returns that are needed for it to happen. And in fact, if you want proof of that, the percentage of, for instance, US and international funds underperforming their benchmarks each year, the percentages, 88%, 87%, 91%, the majority of them basically underperform every single year. Okay? And let's not forget, it's not just an annual return. I mean, you might just get something like this. That's 28% from just October. 28% from just October. And as I've shown you already this year, you're up some 10, 15%. That's a double your money in 5 years kind of run rate, let alone if you get a great year like we did last year with a tailwind where the Nasdaq's up 55%, you'd be looking to double your pension in a shorter period. And let's not forget, the 10-year annualized return of the S&P 500 is 15% in sterling terms. The source of that is, well, JP Asset Management. Okay, it's 12% in US dollars. 10-year annualized return. So it's 15% per annum. So over the last 10 years, you should have been, well, doubled your money after the first 5 and then doubled it again. So 100,000 should have become 200,000, which then becomes 400,000. So in the last 10 years, you should have had 100,000 become 400,000 in your pension in pounds by just tracking the S&P, let alone trying to beat it and do a bit better by cherry picking good companies, which is what I try and teach people. So has your wealth manager done that? If not, point this out to him, take a shot at that and say, okay, you idiot, why didn't you do it? And he'll say, well, you don't want to invest in those cheeky American companies, they're too dangerous. And then point out to him, well, that's JP Morgan Asset Management. Tell me what they're doing wrong that you're doing right, Mr. Wealth Manager. Okay? Anyway, let's get back to the stocks. You can see here, Microsoft, you're paying $31 for every dollar in future profits. So the price to future forecast earnings is 31. It's only 11 on energy. So you can see in green the cheaper sectors. So how come the ones in red, the most expensive ones, are the ones which have been making the most returns? Well, because valuation is not the only reason why stocks go up. Revenue growth, profitability, now and forecasts can all be reasons why they go up. So profit growth can be a reason. So we want to look at all of those factors, not just any one of them. By the way, coming up, you have got Oracle's earnings and Broadcom's and Adobe's. Keep an eye on for those. They will be sort of market determining, as it were. They'll help pick things. Now, what you can see here is that's the 0 mark. There are certain sectors doing awfully well. People say, is there anything other than tech? Well, yeah, communication services. It has Alphabet and Netflix. Wait a minute, they're tech. Well, everything's bloody tech, really, isn't it? Financials, pretty much everything is on this side of 0, as with technology companies, of course. You probably want to stay away from anybody telling you real estate, but basic materials are looking good. And utilities, you can't go wrong. I mean, you'd be pretty bloody hard pushed to go wrong there. Similar with consumer staples, I've got Procter & Gamble still. Healthcare, some of it. I don't pick based on sectors. Certainly wouldn't want to do consumer cyclicals other than Amazon. I don't pick based on sectors. I pick bottom up, but I just show this out of interest. Remember, you know how I pick value, growth, income, because all those factors impact how a stock moves. Cash return on capital invested from Goldman Sachs Wealth Management. Their research and development team discovered that companies in the top quartile by Croakey generate 30% per annum. Not every company, not every year, but as a rule, so we want that to be green. Sortino and Alpha, high average returns, low downside risk, outperformance of the market. That's what those two combine. So I cheat. I don't say I've been to the right university so I can generate great returns. I just say, well, statistically, these stocks do it. So whilst the past doesn't guarantee the future, it's a pretty bloody good guide, actually. And we know that from the statistical data. Now, exchange traded funds. I'll talk a bit about the leverage ones in a moment, what I hold. The others can be discussed at another time. You can pause this and investigate these for yourselves. What's been doing well? Well, as I said, communications. Okay, it isn't necessarily tech. Utilities, tech, financials, energy companies. Now, as I've said year in, year out, week in, week out, I don't just pick which horse or sector is going to do the best. The way I look at it is which companies are going to do the best, and then whichever sector we're in, that's fine by me. Okay. Similarly, when it comes to these factors like momentum, value, growth, market cap, I need companies to have ticked value, growth, income. So I'm picking a subset of a subset of a subset, the very best of the best of the best. That's why I need 10,000 stocks to start off with and narrow that down. And I don't just say I'll only pick British companies because that'll be too small a gene pool. Statistically, highly unlikely to succeed, therefore. Markets over the past year are up 30% from June last year to June this year. So why isn't your wealth manager doubling your money every 5 years? You're up 30% on the Nasdaq, S&P 25, the Dow 15, the UK 17%. These are the top performers on the UK markets over the past month. Let's look at the S&P 500. We'll do that in part 2 of this weekly update.